if we fast forward now it's been a little over a month since all of this news broke. And obviously SV Bank was the headline of this, but then there were other banks
Mhm.
and other conversations about, is the banking industry in and of itself going to have issues? How widespread is this? How do you feel now, sitting here in the middle to end of April? How What are your thoughts on how the situation is resolving, and just perspective that maybe we didn't have a month ago when all the headlines were hitting, where it was like, one bank after another is being taken over by FDIC, and there's a issue at Credit Suisse and all that stuff. How do you feel it's resolving now?
Well, one of the most interesting things about it is if you looked at March 1 and March 31st, so the last trading day in March, the actual stock market didn't move a lot from point to point. And I forget what the number is at the beginning, but if you told me that we were going to have two banks in the US taken into conservatorship and closed off, and then Credit Suisse was going to be forced to merge with UBS, I would argue that the market should be 5 or 10% lower from where it started.
Interesting.
And it did dip in March, but it ended the month about flat. And I forget what the numbers are perfectly, but it was about flat. Now, where are we, a couple weeks from the end of March? We're a little bit higher then. So, in a lot of ways, at least the equity side has kind of taken that event and shrugged it off a bit. There was, which, potentially is a good thing because the market realizes that this is not a 2008 type scenario where things are going to go up in smoke. This is a situation that was isolated to certain places. What I find kind of interesting is what the bond market tells us. And the bond market looks at it, and we can see that interest rates, are lower today than where they were at that period of time. The bond market's telling us moving forward that they don't think the Federal Reserve is going to hike that much in interest rates moving forward, which is
Mm,
kind of a very interesting piece in this.
yeah, it is.
Why that's the case? Because the Fed keeps hiking, bonds are going to continue to go lower in value.
Hmm.
And what was a two bank problem could potentially become a larger bank problem or affect more banks. And the Federal Reserve is going to be very cognizant of that. And it's also going to put some interesting pressure on different banks around the country. We have different levels. We have the JP Morgans, the Bank of Americas. Those are our money center national banks. Then we have your large regionals like PNC, and Truist, and banks like that. And then we have a different level of regional banks like Key Bank and M&T Bank and these different banks around the country. We have community banks
Hmm.
that are smaller and are very specialized in the community they have. And this is going to affect different banks at different levels differently. I know there's a lot of difference right there, but
Yeah, yeah.
each level is going to be a little bit different.
You actually earlier, just in conversation, and I've heard you explain this in the past too. You've done a good job explaining this inverse relationship between interest rates and bond prices. But an example that I've heard you give before that really resonated with me, and it's since resonated with a lot of clients we serve, is, if you just like put yourself in this situation, right? Like, so if you're buying, let's say you're buying a 10-year bond, $10,000 denomination 10-year bond, and it's at 4%.
Mm-hmm.
And then I'm a month later, I'm going to buy the same exact bond from the same issuer, 10-year, $10,000, but it's no longer at 4%. It's at 5.5%. And Michael, you come to me and you go, "Hey, no, 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 don't buy that from the new issuer. I'll just sell you mine." I'd have to be like, "Well, you're crazy if you think I'm going to buy your bond at 4 when mine's at 5.5." The only way I would ever consider that is if I bought it at a discount. So you paid 10,000 for the bond. I might now want to pay 8,000 for that same bond. And you're probably cringing as I'm giving the percentages I'm giving, but I'm using those just for like the perception of like where I think I had kind of I get it. It's an aha moment. It's like I get it now that if rates go up, the value of my bond has since gone down, right?
Yes. So if rates go up, the value of the bond does go down.
Got it. So, and sorry to interject with that. I wanted to, that was such a great example that resonated with me. Kind of like, because it puts you, as you're hearing that, it like puts you in the shoes of like, well, if I'm buying a bond and the rates go up, like, why would it go down? It starts to make a little more sense there. So let's maybe just talk about what is the fallout or the impact to consumers as a result of everything that's happened over the last month to month and a half. You know, you've I've heard you talk before about. Well, you know what? I'm not going to take the words out of your mouth. What is the impact of that?
Well, there's, I think, a monetary impact, and then there should be a behavioral impact, right? What's the monetary impact? Well, if a bank is looking at its balance sheet and saying, we made, these loans in the past 2 or 3 years, whether they're mortgage loans or car loans, and everyone has like an anecdotal experience. Mine's my 2.7% mortgage. And I'm sure you have one about that, and other people do as well. Like, the bank at the time gave us that mortgage freely, but now they're looking at that saying, man, that one's underwater. That one's not worth it to us. So our next mortgage we're going to make has to be worth it to us. And we
Hmm.
also need to make it to the right person, right? So what does that mean? Potentially higher interest rates. Potentially they may not want to make a certain loan to you anymore because they think rates are going to change. They may not be willing to do it. So at the very lower levels in community banks, and maybe your smaller regional banks, they could be more selective on the loans that they give out, and it may cost you more to get those loans, whether it's in the form of interest or whether it's in the form of fees in the beginning. And remember, we talked about in the very beginning here, banks do make money off of fees. So they may say, we'll still give you that 5% mortgage, but we're going to require like a $2,000 fee up front. I'm just throwing numbers out. So
Hmm.
that's one thing that we're going to see. And the really interesting piece about that, and we're going to see what the effect is, but that's almost like the Federal Reserve is raising rates without them actually raising rates. So for the
That's what I
past,
wanted. I want. No, okay, sorry to interject, but I did want to ask you that because so everyone, we kind of hear like, oh, the Fed's raising rates. Like that makes a headline. Everyone I talk to, that's like a topic of conversation. And yes, there is obviously a correspondence between the Fed raising rates and what bonds do, and then ultimately what your car loan, if you're getting a new car loan or a home loan, like what those rates are set at. But then beyond that, there are other metrics that influence rates, and maybe this is a little bit about what you're referring to, and like the restriction in lending or being mindful of like if a bank is having to look at this and say, is this a good business decision or not? The only way they can justify it is if rates increase a little bit more from even where they were. So talk to a little bit about that situation.
yeah, so the banks, a bank needs to be diversified, just like any
Mm-hmm.
investor does, because when a bank makes loans, they're investing in whoever they're loaning money to. So there may be a ratio between how many mortgages they will give out, how many auto loans they give out, how many business loans they give out, how many personal loans they give out, what their credit card business looks like. Depending on how many different lines of credit they give out, there is a certain amount that they're going to give out in each credit tier as well. So we
Mm-hmm.
always talk about having a high credit rating. If you have a high credit rating, you're probably going to get first bat at getting a loan. If you have a lower credit rating, in the past you may have gotten the loan, which is a higher interest rate. In this environment where banks are, concerned about how much money they have and what the loans are risky and which ones are not, and the timing, they may begin to be very picky about what kind of loan they give. And
Sure.
they may, if a bank thinks rates aren't going anywhere, they may give out more mortgage loans. They may give out more auto loans. They may be apt to do that. But also, you got to think, if you're a bank and you're banking to a select group of people that may not hold their deposits for very long, do you want to give out 30-year loans, or do you want to give out 5-year personal loans, and
Right.
different things like that? So that's really what we think we're going to see, is that banks are going to get more choosy and make loans more expensive, which is, kind of what we think the Federal Reserve has wanted to occur over the past, year. We're going to begin to see that from the banking side, and that could put a little bit of a bite into the economy and slow it down a little bit.
Well, so that's interesting in that that's how it would affect American consumers potentially in one regard from the standpoint of homes or auto loans or savings rates and things. What are your thoughts on from an investment perspective? So this is a big old fat loaded question here for you. That's really difficult to answer. I know. What Get your crystal ball out and
Yeah.
tell us what the next. No, but I mean, I think the question we often get is, well, okay, is now a good time to invest your money?
Mhm.
And that's obviously a harder thing to answer, and it's very specific in nature to somebody. But what would you say to just as a general answer to someone asking that question?
In the short run, the market can go up and down, and it's going to go up and down in ways that you don't expect them to for different reasons. What we know looking back through history is the market follows earnings over time. And in the short run, there's going to be a lot of volatility. And I can tell you in the next 2 to 3 months, what do we have? We have a debt ceiling debate coming up. And are we going to take it to the brink? If we take it to the brink, we could see some volatility because Congress is playing around with something they shouldn't be playing around with.
Mm-hmm.
That could be concerning. But where will we be a year from now, 2 years from now? It's a lot more likely that it's going to be a lot more positive than
Mm-hmm.
what it could be today or tomorrow or things like that. So when we think about how individuals should place their money, again, it goes back to the fundamentals. What are you saving or what are you investing this money for? Is this for your retirement and you're 25? Put the money in the market.
Mm-hmm.
Are you about to retire and you've had this $500,000 sitting in cash for the 5 years? Maybe there's a strategy, whether it's dollar cost averaging or treasury laddering or doing different things. Maybe there's a strategy to get into the market in different ways. But it's really specific to the investor. What we know is over the long run, stocks follow earnings. And generally
Mm-hmm.
speaking, over the past, 90 years back to 1920, earnings have increased. So,
Yeah.
still positive about that. In the short run, things can be rocky. In the longer run, the data shows that you want to be invested.
It's always hard for me not to be confident when I'm thinking in the longer term picture. It's the uncertainty that can happen inside of 12 months or even 24 months. I mean, it's really difficult to predict where the markets will go. But over a longer period of time, I've always tended to feel a little more confident. But of course, then situationally, it just depends on, someone's goals for their money, and people have different buckets of money that have different goals assigned and attached to them, of course. And I think something that we always talk about is, of course, making sure that you have a plan, and furthermore, the idea that yes, as you approach and get closer and closer to retirement, your portfolio gets more conservative, but retirement is not the end. That is
Mhm.
literally only the beginning. It's the start of for which all the decades of planning that you've worked towards, and now that's starting. And the portfolio still needs to be able to have the opportunity to grow and experience returns over a 10, 20, 30 plus year life cycle with longevity and people living longer and longer these days. And what I will say is it was probably a week or two ago, you published an article called "Why Diversification Still Matters." And sorry if I butchered the title of it, but I think that
It's pretty
was it.
close. It's pretty close, I think.
Yeah. And what I liked about it in the context of this discussion I'm having with you right now, it was sort of relating it back to everything that's gone on in the banking crisis. And, you had some very good practical tips, which I'd like you to share here in this conversation. But I thought it landed really well for me because it was such a great reminder that example of what's going on in this banking issue does parlay very well to how diversification not only matters there at that level, but also within your portfolio. Maybe just share a little bit about some of what you shared in that article.
Yeah, I think it's important to realize that most people understand that when they invest money, whether it's in stocks or bonds or their portfolio as a whole, it's important to be diversified. You don't own your entire portfolio of one stock. You don't have your entire bond portfolio in one bond. You should have some diversification there. But this situation with the banking industry showed us that diversification still might matter with your deposits. And even though in this situation, and going back to the 2008 situation, depositors never lost any money,
Mhm.
investors bore all the losses. It's important to note that the FDIC insurance, that what backs all of our deposits, is not paid for by taxpayers. It's paid for by the banks. The banks pay into that pot. So when we talk about letting the SVB depositors get their money, it's not like the taxpayers are going to write this check and it's going to the national debt. This money is coming from the banking system already.
Hmm.
So I think that's important to notice. But I kind of get a chuckle out of it when people talk about the FDIC limit because it really should be irrelevant to most people. Not because 250,000 is above what most people keep into the bank, but let's say you're a married couple and you have a joint bank account. Each of you gets 250,000 on that bank account. So the first 500,000 in that bank is guaranteed. Then different brokerages offer bank deposit sweep programs. And this is something that we utilize as well, where your money in your brokerage account, not your investments, your investments are not guaranteed, but the money that's in the specific bank deposit sweep program overnight goes out to a bank and it goes out to a network of banks. And I think the one that we use has something like 15 or 16 different banks. So if you do the math there, one person at 250,000, you can get a couple million of guaranteed
Hmm.
cash.
Hmm.
And then if it's a joint account, let's double it, right? And if you're someone who has cash in excess of that, why are we not laddering treasuries? Because then we can just go to the treasury market and guarantee this out in short-term treasury notes and roll them. If you have 5 million in your account that's in cash, chances are you're working with someone who is going to be able to ladder the treasuries for you. So
Hmm.
this whole
Hmm.
FDIC concern really for most people should not be a concern, whether you are someone with $10,000 in a bank account or you're a multimillionaire with millions in a bank account. There are solutions for you. You just have to diversify how you hold your cash.
Well, I often say the very proverbial quote, knowledge is power. And I do feel that just even hearing you share some of that stuff, a lot of us sort of get doled into that like 250, like that's the limit. And there's much more to unpack from that. And recognizing that there's other opportunities out there, I think is really important. Hey, Michael, so as we wrap today, is there any maybe parting words of wisdom or thoughts as it relates to this banking crisis or just the current state of affairs that we're in here in the middle to end of April?
Yeah, the number one thing that I think of, and the market's kind of done a good job of it this past month, is that every year, looking back, whether it's 2023, whether it's 2022, 2021, going back to, I'm sure we go back a ways, but I know off the top of my head, if you go back to 2000, there's going to be a reason to not invest. Every single year you can convince yourself that there's something going on. I think 2006 might have been an odd year where nothing bad happened. I think Pluto lost its planetary status that year, which was like the most notable headline. But otherwise, this is very true, by the way. I can show you the data on this, but there's always a reason to not invest. Don't let these different situations scare you. Work with somebody who can help you through it and what strategy is the best for you. Whether you're just starting out, you're mid career, approaching retirement, or in retirement, there are solutions to handle these different events as they come up.
I think you just came up with like our next podcast idea. It could be like satirical, like 100 reasons not to invest. And we could do like the year that Pluto was no longer a planet. That sounds like a fun one. What do you think?
I think we can do that. That's 2006,
Cool.
by the way.
Yeah. Love it. Well, hey everyone, thank you as always for listening to us today. I think that this is a really important conversation for us to share as some of the dust has continued to settle. But I would encourage you, we always make our best efforts to keep folks in the know on stuff like this. So canterpath.com/blog. You can also maybe we can drop like a link to Michael's LinkedIn page because he's also very good at sharing and publishing new articles and things that are happening just to keep everybody in the know. So thanks as always for listening to us today here, and we will talk to everybody soon. See ya.
See ya.